long-term care. Right? And for those of you who don't know about what the costs are, I put this on the chart. That if you're looking at private home care services, someone coming in the house to take care of you or your loved one for activities of daily living, bathing, cooking, toileting, food preparation, taking you out for a walk, taking you to the doctor, you're on average looking at about $18 to $20 an hour. Okay? Private pay. All right? It varies. If you hire an agency, you can find a nice lady to move in and you pay her cash. Whatever the deal you can do, that's great. But this is the kind of hours you're looking at. And if you get into, 4 hours a day, 10 hours a day, 24 hours a day, it can get very expensive and can get as expensive as putting a person in a nursing home, which of course we never want to do.
Right.
So what does nursing home cost? If God forbid you have to go to a nursing home. If you're looking at nursing home in New York City area, it's $500 a day plus. Okay? Easily $15,000 a month. All right? I just went through a bill for a client. It's $18,000 a month. Right? So people who have savings, even if you said, well, I'm pretty good. I have like $800,000 in savings. I have $1 million in savings. But then if your spouse gets sick and you start spending $175,000 a year in nursing home, your million is not going to be there much longer. And then the surviving spouse who's well at home is not going to have money to even live on. So that's why you have to look into avenues and options in helping to help defray the cost or cover the costs. Okay? If you have millions and millions of dollars, you're not going to have to worry, pretty much. But if you're on that area, which people say, oh, millionaires going on Medicaid, it's not true. It's not true. All right? Now, people who have like $800,000, $500,000, they're going on Medicaid because that doesn't last long in this kind of expense area. All right? Okay, next slide. So there's different options for paying for long-term care. All right? The top one is just cash money. You got a lot of money in the bank, okay? No problem. Just going to be spending it. Hopefully you don't outlive the money. I have clients who come to me and they have a lot of money, and I'll talk them out of going on Medicaid and so on because it's just not worth it for them. All right? Because you have this, Medicaid's not the easiest program to get onto. All right. Is this working now?
Yes, sir.
Oh. Give it a try. All right. Can you hear me better?
Yeah.
Where's the speaker?
So, yeah.
Oh, up there. All right. All right. Now I can yell at the mic. Not that loud. All right. So the top one is cash money. Then you have on the red one is Medicare, which we'll discuss. Medicare does not cover long-term care. Okay. People often say, "Well, no, I'm not worried. I have Medicare." Medicare does not cover long-term care. And we'll cover that in a second. Basically, it just covers rehabilitation services. Okay? And then you have over there on the right, Medicaid, which we'll go through in a little more detail because that's actually the bigger program we should be worried about. And then at the very bottom, you have long-term care insurance. So these are the four things that people think about when they think about financing long-term care. And the one actually that does not cover long-term care is the red one, Medicare. Right? Many people, because people stay healthy now into their 70s and 80s, and they go, "Oh, I'm not worried. When I get sick, I'll have Medicare." What they don't realize is now, when they're after hospitalization, and they're coming out of the hospital, and after a short period of rehabilitation, there's no coverage. You're on your own, and you can cash out of your pocket. Okay? So let's start going through some of these different programs. Next page. Okay, Medicare. As it says here, rehabilitation only, short-term rehab. So you fall down, you break a hip, God forbid. They go in, they fix you up, all right? After a 3-day hospital stay, you're entitled to, so Medicare covers the hospitalization. Then you're entitled to 100 days of rehabilitation. Question mark, maybe. Because if you are not constantly improving during those 100 days, they stop the coverage. So you may only get 50 days of coverage. You may only get 75 days of coverage. You may only get 40 days of coverage. The only thing you're guaranteed is 20 days. The first 20 days after you come out of the hospital, you're covered at 100%. And after that, you have co-pays. That's why you have Medigap insurance that you may buy from AARP or wherever, and so on. So, and also there is a small amount of home rehabilitation for about 3 months at maybe 3 or 4 hours a day. All right. So sometimes people come out of a nursing home, rehab center and say, oh, I have some care. Well, that's from Medicare, and that's only going to last about 3 months. Then they're going to stop. I mean, there was a recent lawsuit, it was in the New York Times, about expanding that. But there's going to be many, many years before they finish interpreting in that law and getting in place for anyone in this room. I can't see benefiting from that, so I'm not going to go into that. All right. So just know that Medicare does not cover long-term care. It's just transitional to get you back on your feet. And if you can get over your stroke or get over your broken hip or broken arm and back walking and cooking and talking and doing your own stuff again, then that's great. But many people, like the gentleman here is caring for his wife, you do not improve. So you're going to need ongoing long-term care perpetually. Okay, next slide. So then, of course, there's long-term care insurance. And probably if you haven't bought it by now, you're not going to buy it. Right? And I would say 90% of my clientele have not bought long-term care insurance. All right? So I always tell families, children come to see me about their elderly parents or grandparents or aunts or uncles, and they go, well, he didn't do any planning. He wouldn't let us touch his money, he wouldn't talk to us, whatever. I said, don't feel bad, that's 90% of the people. No one wants to give up control of their money, no one wants to give up their autonomy, and that's, as another alternative, I accept that. And the person should stay in control as long as they can. But at some point, you gotta let go. So these just give you some basics. I'm not an insurance broker. I'm not here to explain how to buy long-term care insurance, what to do or whatever. But all I'm going to tell you is that when clients ask me, I say, buy the best you can afford if you're going to buy it. Okay? Because you don't know how many families come to see me and say, my father was paying for this long-term care policy for 15, 20 years. And then we find out it covers $100 a day in the nursing home. And what did I tell you on the first chart? It's $500 a day, right? So yeah, it helped a little, but now they're still coming to me to get Medicaid. Because you need Medicaid plus the long-term care policy. They go, if I'd known that, we would not have paid all those premiums, just put the money in the bank. And some people say that, if you read the articles. If you are disciplined enough to take that, I put down some numbers here about how much it costs, but if you're disciplined enough to put, $3,900 a year or $4,000 a year in the bank and invest it for the next, you have some money to take care of yourself. I mean, some people think that way, but all I can tell you is that buy the best you can afford. It's not available to anyone once they've had a major illness. So if you're already kind of ill or have a diagnosis, no way. After 79 years old, no, right? The average cost here for a 55-year-old is about $1,500 a year. The younger you buy, the younger you buy it, the cheaper it is. But of course, when you're younger, you think you're going to live forever and never be sick. So why waste the money, right? The rates increase with age. And as I already told you the story, people with long-term care insurance still come to see me because they don't realize that they're paying all this money and they don't read the fine print. No one really looks at what the benefit is. And I've had even children come to me and say, I've given up trying to collect their mom's policy. I filed so many claims and mom's at home and we need home care and they say first you need to have this proof from the doctor and you need so many hours of activity daily living. And they give up. They go, it's not worth it. And then there's some basic things you pay attention to, which is elimination period. Like most people say, my insurance is going to kick in after 90 days, right? So I get a cheaper premium. That's 3 months. So 3 months in a nursing home, right? $18,000 a month. It's a lot of money out of your pocket to start with. So people don't even think about these little things. You want inflation protection because if they say we'll give you $100 a day, well, after 15 years, that $100 a day is not what it was. It should be like $200 a day. Right? And then you want to see what it's going to pay out daily. Again, people are surprised that it's only going to give them $100 a day or $125 a day. So just be careful when you do long-term care insurance. It's fine to get. I'm not opposed to it, but if people just don't know what they're buying when they buy it. Okay, so next slide. So finally we get to the big thing that I deal a lot with is Medicaid. And there's a lot, probably I find that people don't know about Medicaid, or that they have been incorrectly told. And I think it's actually Medicaid itself that perpetuates the misinformation, because it's the job of the Medicaid program to save the state of New York money and keep you off Medicaid. Right? We have a New York State budget of over $60 billion for Medicaid. Okay? People who get sick, who've retired to Florida and Arizona, move back here when they get sick. Okay? Because, why? And people say, well, those older people in Florida, why don't they have good Medicaid services? Well, because the more services you offer in a state, the more taxes the state has to collect to pay for that. So people retire to Florida because it's cheap to live there, but when you get sick, there's like zero home care by Medicaid. Whereas opposed to New York State, you get up to 24-hour live-in services still. New York City, all right? And they're far much more generous on nursing home benefits. So children who come to see me and they say, Mom's a snowbird, she has an apartment in Florida, she's been living there, but now she's sick. When I explain the rules, which I'm going to do now, they say, that's it, we're packing Mom up, flying her back home, pop her back in her apartment or in our apartment, and you're going to get services, all right? And it's an interesting fact that Medicaid in the whole country, all right, Medicaid covers 50% of the long-term care bills. People don't realize it. So Medicaid has become sort of an ingrained part of, as we call it in elder law, instantaneous long-term care insurance. Even though it was designed for the elderly, poor, and disabled, it's become instantaneous long-term care insurance for people who have money if they go see someone who knows to explain the rules, which I'm about to explain to you. All right? Now, Medicaid is a means-tested government entitlement, which means they're going to look at the person's means of support, their income and their savings. Unlike Medicare, they don't care how much money you have. Right? Donald Trump will get Medicare when he gets retirement age. All right? He's going to have, well, we don't know what he really has in the bank, but whatever he's got in the bank, all right? They don't care. But Medicaid does care. They're going to look at what income you're getting every month, Social Security, pension, whatever, and they're going to look at what money you have in the bank. All right? The rules vary from state to state. Today, we're talking about New York State. There are 50 different states. There are 50 different Medicaid programs. So even if you're just going across the bridge to New Jersey, you need to consult an elder law attorney in New Jersey. You go to Connecticut, Connecticut. Okay? But again, those people who are in New Jersey all come running over to New York State, because New Jersey is one of the most restrictive Medicaid states to try to get on Medicaid. Now, a big thing here is that Medicaid works with Medicare and any other insurance you have. You do not drop any other insurance you have. You just get an extra card in your pocket. Okay? So people often say to me, well, Mom's going to have to drop her Medicare and all her doctors. No. The Medicare card stays in place. You can go see all your Medicare doctors as was before you applied for Medicaid. You just get an extra card, and the card now, Medicaid's smart. Medicaid says, keep all the other insurance you have. And we, Medicaid, will sit back and cover whatever they don't cover. And as I just said, Medicare does not cover long-term ongoing home care or nursing home care, right? So even if you were in a nursing home or on home care Medicaid and you got sick, Medicare would cover the hospitalization. Then you go to rehab for 100 days, Medicare would cover that. And when you came back to the nursing home, when you came back to your home care setting, Medicaid kicks in back again, all right? So you do not drop Medicare. It's a common misperception, all right? Medicaid does not supplant or replace your Medicare. It's just an extra insurance as a backup. Now, Medicaid, as I said before at the beginning, can cover up to 24 hours a day live-in services. Someone living in the apartment caring for you 24 hours a day. All right? Of course, it's getting harder to get because, of course, that's expensive. And Medicaid has just shifted their home care program to more of an HMO type program, where they're farming it out to these agencies and they're giving them a fixed fee. There was a big scandal in the New York Times about visiting their service of New York, enticing people to sign up, right, and giving them vouchers to go to the casino and giving them free takeout food or whatever. So they've been banned from enrolling new enrollees for a while until this investigation's over. So, you know, there are pluses and minuses to an HMO program, and that was one of the minuses. But Medicaid, because it is complicated, is so generous in New York State. Medicaid application process is complicated. And it's like doing income tax, I tell some people. So that's why people like me exist. You can do it on your own. You can come to an attorney and do it, or a social worker, or a geriatric care manager. it's just like anybody. It's like people say, well, why do I need to hire you? Well, you don't. It's a government, state, federal program. It's like, but I said, who does your income taxes? Oh, I go to an accountant because I can't figure out all the rules. Same thing. If you're good and can figure out the rules and want to do an application, I tell people, please do it yourself. You save a lot of money. But if you can't, and it's usually the children who hire us because they're busy, they're working, they have no time, they're worried about their parents, and they don't have time to take out work and figure out the application, and they can then get it rejected and have to do it 3 or 4 times, and so on. Okay, next slide. So let's get into some details about Medicaid. There's different kinds of Medicaid. It covers different kinds of services. The first one, it covers home care. So you can just apply for home care. Then you can apply for nursing home services. That's full-time residency in a nursing home. And one thing I'll comment here is all nursing homes accept Medicaid. People often come to me and say, well, I don't want to go on Medicaid because I don't want to put my mom in a Medicaid nursing home. Okay? There's like no such thing. Every nursing home in Manhattan accepts Medicaid. Because the rule is that if they don't accept Medicaid, then they can't accept anyone on Medicaid. And I'm going to tell you now, everyone who's in a nursing home is mostly, well, if you didn't start out on Medicaid and you run out of money, you're going on Medicaid. All right. So you pick the best ones in Manhattan, Mary Manning Walsh, Isabella, whatever, all accept Medicaid. And the final box is some people just use it for like pharmacy and doctor. Those are more people on the edge of life and the homeless and other people. I mean, there's many other categories of Medicaid. There is for teenage pregnant women. This is why the application is so complicated. That one application they give you is for the whole spectrum. I mean, I give lectures at the Alzheimer's Association every month on doing Medicaid applications. It's free, so you can actually go there and listen. And they go through and they go, they're applying, they're there for their mother who's has Alzheimer's, 80. And one of the questions, are you pregnant? And how many children do you have under 21? And they've always been, they go, we have to answer, and yes, you have to answer it, it doesn't apply. Because this application is for the whole, from anyone from, 17 or baby children or, whatever, all the way up to 90-year-olds. So you have to sort that out and decide what you have to answer on the application. All right, next slide. So as I said at the beginning, it's a means-tested government entitlement, which means they're going to look at the person's means of support. They're going to look at their income, monthly income. If the income is too high, above what Medicaid says you're allowed to keep, they're going to push you into what's called the surplus income program. And that's what this gentleman started talking about. They want $85 a month. We'll talk about that. And then they talk about resources, assets in the bank. And if you have too much money, you're here to see me about is there some way to protect that money and move it away so Medicaid doesn't get it, so-called, whatever. And then finally, there's miscellaneous. You're going to want to see birth certificate, picture ID, the death certificate of your spouse. If you're married, they want to see the marriage certificate. There's all these things, and we help people get them because people say, well, I don't know where mom's marriage certificate is, dad died 20 years ago, I don't know where his death certificate is. All these little crazy little things, but they are required for an application. Okay, next page. So income. The income rules are broken into nursing home at the far right and home care, the two at the left. So we start at the far left here. When you apply for Medicaid home care services, that's any community services or anything outside of nursing home. So there's only nursing, for our discussion today, there's nursing home and there's not nursing home. So we're talking about home care, that's not nursing home. Medicaid limitation is that you're allowed to only keep, to live on, $800 a month. Okay, it's ridiculous. Right? As I tell people, we're not even breaking an argument about this. Okay, nobody, virtually no, well, some people on rent control will get like $300 rent, maybe, but $800 a month is supposed to cover your rent, your food, utilities, cable TV, telephone, everything. Because people say, oh, well, of course it doesn't count rent. Of course they give you rent. No, that's everything. And I tell people, Medicaid is like a little foreign country. Okay, you got to cross the border to go live there. They want to see your picture ID, your passport, all this stuff, how much money you have in your pocket. This is all you're allowed to live on there, okay? All right, so if you just mailed in your own application and showed them your Social Security and your pension, they'd say, okay, you get to keep $800, you give the rest to us. So that's what's called the excess income program. So when you apply to Medicaid and show them all your income, they go, fine, you keep $800, and the rest you give to the agency providing the care, like deductible. So the higher your income, the bigger your surplus that you have to give over. right? Now, if you're getting 24 hours a day care from Medicaid and then your surplus is small, it's a pretty good deal, right? So let's say your surplus is $300, right? You're getting $1,200 a month. So your surplus is $3. You have to give Medicaid $300 a month, and they're going to give you an aide that lives in the house and give you 24-hour day care. It's a pretty good deal. But some people are not happy with that. And some people have high rent that are more than $800, right? So you say, well, how can they live? So then you go to the center option. Okay? If a person has surplus income that's being requested by Medicaid, there's a way to shelter it and not give it to Medicaid and keep it. And that's what's called a pooled income trust. A pooled income trust is a type of supplemental needs trust that Medicaid lets a person have on Medicaid. A supplemental needs trust is a type of trust that can supplement your lifestyle and pay for things that are not covered by Medicaid. So in our example, okay, if you were getting, let's say, $1,800 a month in income, and you're supposed to give Medicaid $1,000, you can keep it $800 in your own pocket. Rather than do that, I would say you should open a pooled income trust, because then you put the $1,000 in the pooled income trust, and these are trusts run by not-for-profit organizations in New York State. There's like 5 or 6 of them, maybe more, maybe almost 10 now, because they make money off of this, of course. There's no free lunch in the world. So every month you put your extra $1,000 in that trust, right? You keep the $800 in your pocket for food and groceries and small bills, and the $1,000 is accumulating in this trust. So how do you get the money out? You get the money out by sending bills to there. Okay, you can't take cash out of this trust. So you take your rent bill, if it's small enough, you mail it there. You take your cable TV bill, your Verizon telephone bill, and you mail it there, and they will issue a check to pay it. So you're basically getting your money back that you're putting in the trust. Of course, they charge a management fee, 1% a month, but I'd rather have you pay 1% a month to them than just give the $1,000 away to Medicaid and you never see it again. Okay? So that's how we deal with sheltering income. Now, is it cost beneficial? I mean, the gentleman over here mentioned that they're asking for $85 a month income. That's kind of on the low side to open this trust, but still, you get some of the money back, but you put 85 in, they're going to take 1%, $8, $9 a month from it. After it accumulates, you can buy something with it, whatever. So, it depends. It just depends. But that's how we deal with dealing with income. Now, on the far right, the whole income picture changes. That's someone living in a nursing home on Medicaid. If you're in a nursing home on Medicaid, you're only allowed to keep $50 a month out of your, let's say, your $1,800 in our example, because you're living there, right? I mean, you're living there. You're not paying rent anywhere. You're being fed. You're being clothed, or whatever. So you get $50 a month, and the rest of your monthly income goes to the nursing home, okay? And then Medicaid pays the rest of the bill. So in our example of $1,800 a month for the income of this person, they get to keep $50, right? And then $1,750 goes to the nursing home, and then the rest of the bill at that nursing home, the $18,000 whatever, is paid by Medicaid. So, now there are allowances. I have in the box there, that maybe you can't see, it's a little fuzzy. If you have a spouse at home, all right, so you just put your husband or wife in a nursing home, you will be allowed to keep some of their income. There is this thing called a spousal income allowance. Okay, I won't go into a lot of detail now, but because the theory is that you were living on 2 incomes in the household. So now your husband or wife goes to the nursing home, and her Social Security check is going to be gobbled up by the nursing home now, and now you're going to live on your 1 income check. Medicaid lets the well spouse keep, it's around $2,800 a month. So people who are fearful of saying, well, I'm not going to place my wife in the nursing home because I'm worried about losing the income check, that should not be a fear, really, because you'll be able to keep up to $2,800 a month the income in the household. All right? All right, so that's how income works. Any questions about income? Yeah.
For the spousal allowance, is there a limit on how much income the spouse in the community?
Yeah, well, good question. So if the question is, if the healthy spouse is like got a big pension or is working and has a lot of income, is Medicaid going to want any of that? Right? Because now they put the husband in yes. there's a rule, but this is advanced stuff. They would want 25% of the amount that exceeds the 2,800. Right? So if you were making, let's say, 2,900, you're $100 over, they'd want 25% of that, which is $25 a month. Which is not a bad, your husband's being cared for in a nursing home now, that's $18,000 a month, you give him $25 a month. I'd say, I think you could do it. But the higher income you have, the more they're going to want. And we're going to discuss at the end, I mean, spouses nowadays are even divorcing over this. And we discuss that usually, between attorneys and their client, we discuss flying down to the Dominican Republic overnight and getting a quickie divorce. And then Medicaid just come after you, so. Okay. All right, next page. All right, so now we deal with the income, the resource rules. All right, so Medicaid's already analyzed your income monthly, so now they look at how much money you have in the bank. Now they only look really at the money of the applicant. So even if they're married, they're not looking at the money of the spouse, okay? Because we do this thing called spousal refusal, which we'll talk about in a second. So for the applicant to get on Medicaid, they can have no more than $14,400 in the bank. If you have $1 more than that, at the time you apply, you're not eligible. So it's very important, keeping track of the money. Now there are certain assets when you're evaluating someone for Medicaid that you don't count, that are exempt, that are not counted towards the $14,400 limit. They're listed here. Personal effects, your furniture, your jewelry, a car, okay? Prepaid funeral of unlimited amount. And the rule goes even further, after studying it recently, the rule says that the person going on Medicaid can pay for funerals for their entire family if they wanted to. I mean, I haven't found anyone who wants to do that yet. No, it's like, if a person has some money in the bank, they go, well, I have no one to give it to, and I'm just going to give it to the nursing home. Okay, I'm going to give $10,000 funerals to all my brothers and sisters, and basic funeral is $10,000 easy, right? So $15,000, whatever. So you can spend. The rule says you can say, I want a $100,000 funeral. It's fine with Medicaid. It just has to be a special contract with the funeral director, fully non-refundable, because there was a big scam going on many years ago. Then you go to the funeral director and say, here's $50,000 or $100,000 from my uncle's big funeral. Goes on Medicaid, he's on Medicaid years, he passes away. Time of the funeral, you say, well, we changed our mind. Cremation, give us a refund. And people were really sheltering a lot of money. So now Medicaid says, fine, you can prepay a funeral unlimited amount, but it's going to be a special, you have to tell the funeral director you're going on Medicaid. They give you a special irrevocable contract. The money can't be refunded. Okay, the next box is a big one people are often surprised about, which is retirement money. IRAs, 401ks, and all retirement money is exempt from Medicaid, counting it towards the $14,000. So Mrs. Smith, who's going on Medicaid, any kind of Medicaid, who has $400,000 in IRAs and $10,000 in a regular checking account, is fully eligible for Medicaid because she's below the $14,000. The $400,000 in IRAs is not counted. It's exempt. Now, of course, as it says in the fine print there, underneath there, you must be taking your RMD, required minimum distribution. If you're 71 and a half or younger or whatever, you have to be taking a distribution, which of course, then you go to the previous page on the income, and that goes into your pool income trust. So don't worry about taking your distributions. But it must be in payout status. For someone who's over 70, there's not a problem. You have to, by law and the IRS code, start taking money out. That rule really applies to young disabled people. Because I have someone who comes in, they go, well, I'm disabled, I'm 60 years old. I have IRAs, but I'm not touching them yet. Because I don't have to. I'm under 71 and a half. Medicaid says, no, you have to put it in, annuitize it and start taking money out. Okay? So it's not a problem for a senior, but for a young person, that's an issue. Next box, which is fuzzy, is your homestead. The home, co-op, apartment, or wherever you're living in, okay, is exempt. Long as it's, theoretically, the rule is a rule about $800,000. If it's below $800,000, they're not going to count it. Okay? I mean, I know in Manhattan you can have much more expensive places, but then you come see an attorney and we'll deal with that. But if your apartment, so if you're going applying to Medicaid, and you're living in a co-op apartment or a condo that's worth, $750,000, Medicaid doesn't care, okay? They don't count that. Okay? What you have to worry about, though, is that when you pass away on Medicaid, that co-op or condo becomes part of your estate and goes through your will to your children, you hope. But who's standing at the first in line when you die at the probate court in the probate of your will? Medicaid. So you'd want to see an elder law attorney about the things you could do to make sure that when you pass away, you're at home, you're on home, you're Medicaid, everything's fine, that you try and leave this apartment to your children or something, things maybe you could do. We're not going to get into that tonight.
If you have a
But
reverse
you're,
mortgage,
excuse me?
if you have a reverse mortgage with the bank,
Well, you could do a reverse mortgage, sure, reverse the equity, you could borrow money against it, fine.
who's first in line?
Oh. Well, who cares? Let them fight it out. Let the bank fight it out with Medicaid. The question was, if you have a reverse mortgage in the house and Medicaid's there, and then you pass away, who's getting the money? Well, one of them is. So let them fight it out. But the children won't. So because they didn't see an elder law attorney about doing something, right? So you should hope to avoid that. But yeah, that's an issue. Actually, I would say my best recollection of the law is Medicaid. Medicaid has a very strong lien under federal law when you die. But I think what would have to be some kind of negotiation between the bank and Medicaid. So just know, now there's a list below of certain exempt people you can give your home to and who you can continue your home to be exempt. Like you can give your house to your spouse, you can give your house to a caregiver child who's been living there 2 years. And that's a big exception. That's why when we interview clients, we ask about their living situation, who's living in the house with them, whatever. And as soon as we hear that, oh, my son lives in the apartment downstairs in our two-family house, I go, oh, we have a big exemption. You can give him the house, and Medicaid won't have any problem with that. Okay, so there's advantages to having consultation with an elder law attorney. A dependent relative continues to have an exempt house. A sibling, a brother or sister who's been living in the house at least 1 year and helping pay bills. So there are all these little exceptions about family members who are in the house, and they're basically exceptions that Medicaid's put in place as a thank you to them, saying that you were in the house, you helped that person stay in the house and looked after them, so we're not going to penalize them for giving you the house. All right, so. And then finally, the last box, which we're seeing less of in New York City, but it's majorly focused in New York City, are restitution and German Holocaust survivors. Those people who are receiving restitution from Germany, income, or have accumulated that money in a bank account, it's totally exempt.
wow.
Okay, so the income is not counted as it comes in, and of course most Holocaust survivors don't spend it, they just keep piling it in the bank. And then the bank account there is exempt, and they can pass it on to whoever. Okay, so that's resource rules. Okay, now what happens if you have more? So therefore, we know most people have more than $14,000. So let's see what you do with it. Next page. Question.
In counting your assets, do you count the life insurance policies? The value?
Good question. What about life insurance? Well, there's two kinds of life insurance, right? There's term and there's whole life, right? Term has no value. You just get money when the person gets money when you die. Whole life has a cash value. If it says cash value in your policy, that cash